IAS 37, provisions, contingent assets and contingent liabilities, a very important standard. Now, before I actually start the standard, right, let me tell you the reason behind why this standard came into existence, right? I believe you guys have heard about this concept, prudence concept, right? What does prudence concept mean? Anyone? Nikhil, what do you think prudence concept is?
I don't know about.
Prudence concept means that losses at the time of anticipation should be recorded, right? So if you anticipate a loss, the moment you anticipate it, you need to record it, all right? That you need to take its impact in the profit and loss statement, okay? Whereas a profit or an income or a gain will only be recorded once it's been realized, all right? So the provision itself, the term itself is that you provide for an upcoming event that could lead to a loss, right? Provision means that you provide for an event that could lead to a loss, upcoming event. But that upcoming event depends or basically came into existence because of a past event. For example, let's say um, if you remember IAS 16, right? Now in IAS 16, we studied that there was we were trying to install an oil rig, right? And that oil rig in in the middle of the seabed, and we were doing offshore drilling, right? Now, as a result, for example, or let's take another example. Let's take another example. You guys know that people work in coal mines, right? So the people working in the coal mines, the laborers and the employees, they obviously face significant risks of the mine collapsing or the poisonous gas that comes out. They could die because of that, right? Now let's say, and there has been an event in the past, not in not in Pakistan, but in the southern Asian region. Okay, so what happened was that people were obviously under the mine, and the mine itself was very risky. The geographical experts said that this mine itself is risky, and there is a high probability that this mine will collapse. But if we dig to the right depth, or we do the right we apply the right technique, we might be able to get significant coal out of it, all right, significant amount of coal out of it, right? Ultimately, the owners of the mine or the company that was operating it didn't listen to the geographical experts, and they were all about money, right? They were all about monetizing this risk, so they took it. And as a result, the mine collapsed. Approximately, I guess it was 150 or 180 people who died, right? So it was not just because of the collapse, because the collision of the mine. It was because of the poisonous gas as well. Some people died because of that as well, right? Because in the surrounding region and stuff. Now the point is, because of that past event, that means collision of mine and the death of people. The moment it happened, the company itself anticipated that in the future, in the upcoming future, there might be an amount to be paid to these people, to the families of these people, as a loss, because it's eventually it's an expense, right? So the moment this happened, the moment this event took place, a present obligation arose, because of which they recorded an expense in the P&L based on the estimate of outflow of resources that they expect they'll have to pay to the families of the deceased. You understand? So this, it's not like they've paid it. It's just that they anticipated it, right? Because of the past event, because of the collision of the mine, they anticipated that there might be an outflow in the future, right? And they recorded that outflow as of today, in present, right? Because of the present obligation as a result of past events. So now, the scenario that I explained to you, it's a practical scenario. It happened, right? And if we look at it, it satisfies all three conditions that we need to create a provision. Let's discuss those three conditions, right? Number one, present obligation as a result of past event. So did a past event take place because of which a present obligation came into existence? Yes. Right? What was the past event? Guys, what was the past event? Nikhil, what was the past event?
That collision of minds.
Exactly. The collision of mind took place and the death of the people, right? Because collision of mind, had the death didn't take place, obviously you wouldn't have to pay any money, right? But deaths took place, people died, because of which a present obligation arose, and a provision or a loss in the P&L was recorded against a provision, right? So present obligation as a result of past event exists, right? Outflow of resources must be probable. Now this has some little details as well, I'll tell you, right? So obviously when you've seen people die, you can expect that there will be an outflow, right? Based on, let's say, past practice, because in past, the mines, other mines, not for example our company, but other companies that were operating the mines, events happened over there as well and they had to pay, so we can expect that we'll have to pay as well. All right. And third, the payment that you will be making, because right now you can only estimate an outflow, right? You cannot say it for certain, you can just estimate an outflow. The payment that you're making, or the payment that you will be making in the future, basically, you need to have a reliable estimate for that payment as of today in order to record a financial impact, in order to book a double entry for it. All right. Now, if we get into details of present obligation, the chances of outflow and the reliability of estimates, we get to know that, for example, let's get into detail of present obligation. Now, this obligation could be legal, which also means contractual, because contract is also legally binding, right? Or it could be constructive, right? Legal means that the the obligation would arise as a result of, let's say, a court settlement, right? Or as per the law. For example, there's a law that says that if people in your mine die, you pay, let's say, at least $1,000 per person, right, to the families. So that's required by law, right? Constructive means that either you have published, you already have published policies against such events, right? Or or you have settled in the same manner in the past. So either the published policy, because again, law is something that you have to abide by, right? You cannot ignore law. Okay, so that is obviously binding. So a binding present obligation will certainly be recorded, right? But constructive only gets binding. Listen to me very carefully. Constructive present obligation, because constructive, I told you, could be because of two reasons. Number one, published policies of the company itself. Number two, past practice of the company. So it's something happened in something similar happened in the past, and the company settled for it in the same manner. Okay. So the constructive present obligation is only binding if it creates a valid expectation of being compensated by the entity. All right. So valid expectation amongst whom? Amongst the people, or amongst the entity, or amongst the enterprise that got affected. All right. So valid expectation amongst the affectees. All right. If your published policy creates a valid expectation, let's say, let's take an example over here. When you go and buy a new car, right? You get a warranty card. Yes. And it says that if let's say you come back to Toyota for within a year for minor repairs and maintenance, it will be free of cost, or you'll get 20% discount, or you'll get 40% discount, 60% discount, right? So as soon as you're, let's say, you're driving your car, it's a new car, it's just been 6 months. As soon as your brake pad starts making noises, what do? You look at the warranty card and you say that, okay, fine, I have an opportunity to claim it, claim this repair from Toyota for free, for example. So this warranty card, this policy that has been published by Toyota creates a valid expectation in you, right? That you can go back and you can claim this expense for free, or you can claim this repair for free. You get it? So this is where there could be two types of present obligations. Legal gets binding because of the law. Constructive gets binding because of the valid expectation created amongst the affectees. You understand? Guys, do you understand or not? Rushal, Nikhil, Ahmed, do you guys understand?
Yes, sir.
Okay. Now, once you've identified, again, in any case, you have to make sure that if the present obligation exists and the next two conditions are met, you have to record a provision, right? Provision itself is a liability. I'll tell you how to record a provision, okay? Second, outflow of resources must be probable, right? The, the word probable comes from chances of outflow, likelihood of outflow, right? Chances or likelihood of outflow. There's a table that I've drawn over here. This is not something that IAS 37, explicitly tells us, but based on the information given in IAS 37, we can draw this out, right? We can, make sure that, or we can basically uh, deduce this from the principles of IAS 37, right? Now, if the chances of outflow or the likelihood of outflow is less than 5%, we're not going to look at this right now. All right, we're not going to look at this. All right. So if the chances of outflow are less than 5%, now who tells us the chances? In most cases, a lawyer. All right. In most cases, a lawyer. But for example, do you think Toyota needs a lawyer every time they want to identify how many cars will come within 1 year for a warranty claim? Obviously not. So there's an element of past practice involved as well, right? Past statistics or past practice. All right. So if the chances of outflow are less than 5%, that means the chances are remote. All right. That means the chances are remote. And you do nothing. Okay. You don't record any entry, you don't make any disclosure, you don't do anything. Okay. If the chances of outflow are anywhere between 6% to 50%, 6% to 50%, that means the chances are possible. Even in the exam, the examiner will use this term possible. All right. So you have to, when you're solving a question on provisions, contingent assets, and contingent liabilities, you have to make sure that you identify this word possible. Okay. If there is a possibility, this liability becomes a contingent liability, which I'll explain you in a bit. All right. If the chances of outflow ranges from 51% to 90%, right? 95%, like not 90%, 95%, right? This is where you say that we need to record a provision, because this is where you call, or you say that the chances are probable, the chances of outflow are probable. All right. And you create a provision. You create a provision, you say P&L debit, provision credit. Why? Because if you look at the definition of provision, it is a liability of uncertain timing or amount. And I explained this through an example without, before telling you the definition, right? I explained this through an example. A liability of uncertain timing or amount. That means the timing or the amount is uncertain for this kind of liability, right? Now, If the chances are more than 95%, then you call it virtually certain. You call that the chances are virtually certain that you will have to pay. And at that stage, you record liability because everything becomes certain at that stage, right? So the timing and the amount both become certain at that stage. So you record an actual liability. Okay, you don't provide for it. You record an actual liability because the chances are, because the outcome is clear now. All right. So you don't need to record a provision. You don't need to estimate anything. You just record the liability. Okay. Guys, you get this?
Yes, sir.
Okay. Now, third thing, reliable estimate. Having a reliable estimate is very important. IAS 37 says that there are two ways of getting a reliable estimate. Number one is the most likely outcome, and number two is the expected value analysis, right? Most likely outcome or expected value analysis. Now, most likely outcome is usually used in court cases where you could have multiple outcomes. Listen to me very carefully. There's a fine line between when to use most likely outcome, when to use expected value analysis, right? Most likely outcome is where you can have multiple outcomes and you allocate probabilities to each outcome. For example, you expect that there will be no payment, so zero payment. You expect that there will be a payment of $50,000. You expect that there will be a payment of $100,000. Now, obviously, these payments, are basically drawn out um, by a lawyer, especially in a court case, right? So you allocate probabilities or weights to it, right? You allocate probabilities or weights to it. So there's a chance. Let's say there's a 5% chance of zero outflow, and you understand that mathematically probabilities should end up at one. One means 100%. All right. There's a 45% chance that you will pay 50,000, and there is a 50% chance that you'll pay 100,000. All right. So 50, 45, and 5 makes it 100, right? So 1. So you add this together and you make a provision for this amount, 72,500. Okay. You add this and you make a provision for 70,500. Obviously, I'm not saying that the actual payment that you will make in the future will be the same as that you have provided for right now. It could be different depending on if it's an upward, if it's towards the north, what do? You record an extra expense. If it's towards the south, you reverse the provision to record an income. Okay. So this is what you have to understand at this stage as well. Now, this is where most likely outcome is basically plays its role. Okay. Expected value analysis plays its role where the outcome is just one. There's just one outcome, but you need to figure out, you need to estimate what value of or what amount you will expect to pay in the future as a result of this obligation. This is applied usually in the case of warranty provisions because the outcome is one only, right? That means let's say you sell a car, there's just one outcome that the people come within 1 year and get it fixed for or get repaired for free. Obviously, it's free for them. It's not free for you. You'll have to incur some cost on it. Okay. So basically what you do is you estimate how much cost will I have to incur based on the sales I've made. So for example, let's say Toyota sells 10 million cars, right? And each car is worth $35,000. All right. So this is the number of cars sold and this is a total sales value. Total sales value. All right. Toyota, based on past practice or historical data or past statistics, figures out that 30% of the cars come back, which is a huge estimate, by the way. All right, 30% of cars come back and get their cars fixed within 1 year, right? So that's how many cars? 3 million, right? That's 3 million cars coming back within a year and getting repaired. All right. Now, let's say Toyota also identifies. Now, this is how you say that this is probably the most reliable estimate that they've given out. Okay. They further bifurcated the type of repairs that they've seen in the past. They see that worst case scenario, we'll have to basically incur 5% worst case, right? So out of these 3 million cars, 5% will be worst case scenarios, 20% will be moderate cases, and the remaining 75% will be of least concern. That means lowest cost will be allocated to them. So for example, replacement of a brake pad, or replacement of or not even a replacement. Let's say there's a small dent on the body of the car and you just have to pull it out. That's all. Okay. Now what they estimate is that the cost to repair worst case scenario comes out to be, again, all of these are estimates. There could be worse than 15,000, right? So cost to repair one car with a worst case scenario is, let's say, 15,000, right? Cost to repair a moderate case is $7,500, and the cost to repair, let's say, least concern car is $1,500. All right. So in this scenario, what you do is you simply try to calculate the expected value of cost that will be incurred towards the repairs within 1 year of the sale, right? So that's 2.25, that's 4.5, and that's 3.375. All right, it's in billions, by the way. It's not millions, okay? So what you do is you calculate the total, which turns out to be 10.125 billion, right? And if you calculate it as a percentage of the total sales value, turns out to be 3%. All right. Now, this is just analytical. I'm not saying that you record it 3%. This is analytical procedure in a way, right? So what you do is you record a provision of 10,125, all right, based on the sales that you've made. You understand? This is how you work out the expected value. Guys, do you get this or not? Nikhil?
Yes, sir. Yes.
All right. Okay. Now, what if the, let's say, what if the chances of outflow are possible? Or let me tell you in a very fine way. What if both the timing and amount are uncertain? Look at the definition of provision. Is a liability of an uncertain timing or amount. What if it's and? A liability of an uncertain timing and amount turns out to be a contingent liability. Why? Because the amount cannot be determined. That's uncertain. Number one. Number two, the timing of settlement is also uncertain. Okay. So that is where you record a contingent liability, and recording means that the accounting treatment for contingent liability is that you disclose it. Let me tell you one more thing. If any of these, let's say, reliable estimate, you don't have a reliable estimate, but you have outflow of resources must be probable, so that you have a probability, right? Probability established, and you have a present obligation as well, right? You still cannot record a provision. Why? Because you don't have a reliable estimate. You need to disclose it as a contingent liability. Or let's say the chance of outflow are possible, you have a reliable estimate and the present obligation exists. What do? You record a contingent liability, right? Now, if you look at the definition of contingent liability, it says a possible obligation as a result of past events, existence of which or settlement of which depends on occurrence or non-occurrence of one or more uncertain future events not wholly controllable by the entity. Not wholly controllable by the entity, right? So that's contingent liability. And like I explained to you, either three conditions, if they don't meet, you record a contingent liability. Okay. And recording means disclosure. Okay. So you just disclose it in the financial statements. There's no impact of double entry. Why isn't there an impact of double entry? Because the figure itself could not be faithfully represented. All right. You don't have a reliable estimate for it. It could be relevant. I'm not saying it's not relevant, but faithful representation is also one of the fundamental qualitative characteristics of your of the information that you present in the financial statements, right? So because you don't have a reliable estimate, you cannot faithfully represent this information. So that's why you disclose it. Okay. Number one. Number two, what is contingent asset? Contingent asset is a possible asset that arises as a result of past events, existence of which depends on one or more uncertain future events not wholly controllable by the entity. Again, you'll have to disclose it. All right. But there is a difference between when a contingent asset arises and a contingent liability arises. Okay, let's look at the chart and let's do you guys see any difference between a contingent liability and contingent asset? Right? For an asset, and like I said, prudence, and this is pure application of prudence. Anticipated losses are to be recorded right now, but no profit will be recorded at the time of anticipation. It will only be recorded once it's realized. Profit or income. Income leads to an asset, right? If you recall the definition of income from your conceptual framework, which you studied earlier, right? Income leads to an asset or a decrease in liability, right? But over here, we're looking at the asset aspect of it. Yes? Now, less than 5% chances you don't do anything for both asset or liability, right? So liability is basically an outflow, expected outflow, and this is an expected inflow. Okay. If the chances are possible, you record a contingent, you basically disclose a contingent liability for an outflow, and you do nothing for the asset. Why? Because like I said, the chances over here are, even for an asset, the chances over here are remote. Okay, so you don't do anything. Next step, when you record a provision for liability, that is at the stage of probability, that is when you record a contingent, or you disclose a contingent asset in the books, all right, against any expected inflow. All right, so like I said, it goes one step ahead of one step ahead of one step ahead in case of confirmation for asset, right, as compared to liability. So you need you need one more step of confirmation in order for you to bring this inflow into your books. Now this could be through disclosure or through double entry, but the earlier stage is disclosure. Okay, so you record it as a contingent asset when the chances are probable at this stage. So the definition of contingent asset that we just studied, the possibility, the chance of outflow that talks about possibility ranges from anywhere between 51% to 95%. All right. You record an asset in case there's the chances are virtually certain. All right. You record an asset in case where the chances are virtually certain. All right. That is because it's been confirmed now, right? The inflow has been confirmed now. Okay. You guys understand this? Guys, do you get it or not? Nikhil, you get it?
Yes, sir.
Do you guys have any questions? All right. Now, once you've worked out contingent, the stage of outflow, chance of outflow, or whether present obligation exists or not, and all of these things, IAS 37 further talks about certain events where you can and you cannot create a provision. All right. For example, onerous contracts. Now, what are onerous contracts? Onerous contracts are basically a contract becomes onerous when and at the time when basically the costs, the future expected costs of that contract exceed its benefits. All right. So the cost that you have to incur, because costs are in line with the contractual terms, you cannot avoid that. Okay. The costs are in line with the contractual terms. You cannot avoid it. Okay. So the costs are predetermined. The cost of honoring the contract, right, is predetermined. But the benefits are expected to be generated from the because of this contract. All right. So what happens is, if at any instance this contract becomes onerous, that means costs exceed the benefits, you record a provision. You record a provision. All right. And the provision shall be recorded at the net cost of this contract. That means cost less benefits. All right. Now, the point is, at what time span should we look, or should we assess the future economic benefits, or at what time span should we basically look at the costs of the contract, costs associated with the contract? So it's usually over the contract term, right? You look at the costs based on the contractual terms, right? So for example, the contract is for, let's say, 5 years or 6 years or 7 years or 10 years. You will obviously assess what, let's say there is, you're running a factory, right? You're running a factory and you're making basically a chemical in that factory, right? So obviously you need certain machines and all that stuff. Now the point is, you're paying a rent of 200,000 per year, and you say that, you know let's say the contract is for the next 10 years, right? And you'll be making, because there's no such law that you cannot make this chemical, and you're making the chemical, you're selling it, and everything is in place, everything is fine, right? But there comes a point where, let's suppose the raw material that you need for this chemical, the raw material I'm talking about, not the chemical itself, let's say the raw material that you need for this chemical gets banned in your country because it has other uses as well. For example, you guys know that in today's world, we have medicines based on marijuana, right? We have this CBD oil and stuff, right? So these are basically plants, right? These are plants. So these plants have other uses as well. We know this, right? You know Mexico, Colombia, Chile, Brazil. These countries have a different use for such plants. Okay, so the point is that when you look at this product itself, let's say I'm importing this product, I don't grow it over here, I'm importing this product, right? And I'm making a medicine out of it. Let's say it gets banned over here in Pakistan and where I'm importing it. All right. Now obviously I rented this factory for this purpose only, for creating this drug or for creating this chemical which is made out of marijuana, for example, and it gets banned in Pakistan. All right. So now what good is my factory? Right? So this is where, this is just one instance, this is one example where the contract becomes onerous. All right. The costs of honoring the contract, HONOR, honoring the contract, is greater than the benefits expected to generate from this contract. Right? So what you do is, let's say this is 200,000, right? And this is a 10-year contract, right? So what you do is you start calculating the present value. All right, and you get the sum. This is let's say 7 years. So I've taken an example based on 7 years, that after 3 years this happens, right? So what you do is you get the present value of future rent, right? You get the present value of the future rent, and you deduct any benefits that you expect to generate from this contract. So for example, let's say sale of machinery and sale of equipment that was used in the operation, because now your operation is zero. You cannot run this operation now, right? So whatever you sell, let's say, that becomes your economic benefit, and you can deduct it and record a provision against it. All right, you can basically, you'll have to record a provision against this contract, right? That's one option. Usually the rent agreements, or agreements like these, have a clause where you can basically get out of this contract immediately by paying a penalty. Yes, have you guys heard of this? So that's called a termination penalty. Guys, have you heard of it or not? You can get out of the contract by paying a termination. Ahmed, have you heard of it? By paying a termination penalty. What happens? If this is the case, what do you do? If you also have a clause of a termination penalty, then you record the provision at lower off. You record the provision at lower off. Remember this. Lower off the costs and the termination penalty. All right. So let's say the termination penalty, if you want to terminate the contract right away after the third year, let's say it turns out to be 500,000. Obviously, there's no doubt about it that you will exercise what? 500,000 rather than 973. You understand? Okay. So Ahmed is experienced in this. So let's not get into the details. Okay. So a termination penalty, like I said, 500,000 against 973,684. Which one is lower off? Which one would you exercise? Obviously 500,000, right? So what you're expected to exercise is what you record a provision against. Okay. So 500,000 becomes your amount for provision. All right. Now, the second case is guarantees. There have been instances in the past, and we as nations, we give sovereign guarantees. The government gives sovereign guarantees to the companies, or to different institutions, or even an entity. For example, a parent, right, gives a guarantee on behalf of a subsidiary, that, for example, subsidiary requires a loan, right? And there's a lot of thinking behind it. There's a lot of business acumen behind it, of why should a subsidiary take a loan when it does not have the capacity. And it's better to take it's better that a parent takes a loan, and the parent manages the business of the subsidiary, or the parent basically induces cash into the subsidiary, right? Why is it that the subsidiary is taking a loan, and the parent is giving a guarantee on behalf of the subsidiary, that if the subsidiary does not honor the contract, the subsidiary does not pay you back, we will pay you instead of it. Okay. So there's a whole lot of thinking behind it, but this happens. You ask a subsidiary to take a loan, knowing that it cannot pay the pay the money back. Or, now this is intentional, there could be a genuine business transaction as well. The subsidiary takes a loan, and the parent guarantees on behalf of the subsidiary that if the subsidiary fails to pay the loan, I'll pay you back, right? So in that case, you only record a provision for the payment if it becomes probable that the subsidiary won't be able to pay, that the subsidiary won't be able to honor its own contract. That is when you record a provision. Okay, that is when the parent records a provision, not the subsidiary, because subsidiary is not, it doesn't have the capacity to pay back. So the guarantee triggers in, the bank comes to me as a parent and asks for the money, because I guaranteed on behalf of the subsidiary that I'll be paying the money if the subsidiary fails to settle its obligation. Okay, you guys understand? Nikhil, Rushal. Rushul, I
Yes,
don't get
sir.
any response from you. Why? All right. There's another thing that IS 37 talks about. It talks about environmental provisions. We've studied the dismantling provision in IAS 16. Yes? So the provision element of IAS 16, because the PP is dealt with according to IAS 16, the debit entry, if you remember, the debit entry, PP, debit, and provision for dismantling credit, right? So the debit entry is dealt with according to IAS 16, and the credit entry, which is obviously provision, is dealt with according to IAS 37. And if you recall, I gave you an example over there. I said that, let's say when you're drilling, right, we are basically eroding the seabed. That's fine. We are also disturbing the marine life, right? We're destroying the marine life. So what happens is, now listen to me very carefully. There are two types of arrangements. There are two types of provisions that need to be created. Number one was the dismantling provision, which does not go into the P&L directly, which goes into the P&L over the period of contract, because through PP, because it's capitalized and then you depreciate it, and that is when it's taken to the P&L, right? And the other one is environmental provision. Environmental provision. Okay. Now the point is, we understand what the dismantling provision is, right? IAS 16, I told you an entire story. When do we record an environmental provision? Question is, when do we record an environmental provision? Environmental provision is recorded because, let's say, let's take an example. Because I agreed with the government two things. At the time of the inception of contract, I agreed two things. Number one, I'll dismantle this oil rig and I'll take it with me once I'm done with the operation. Right? Once I'm done with the drilling, I'll dismantle this oil rig and I'll take it with me. I won't leave it here. Right? And the second one is, whatever destruction, whatever damage my company causes to the marine life, we'll try to restore it. We'll spend towards it and we'll try to restore it. Okay. Now, these are two separate commitments. One commitment is reflected through the dismantling provision, which I've already recorded, and it's capitalized. As per IAS 16, it is capitalized. And I told you the logic behind it as well. Why do we need to capitalize it, right? The second one is environmental provision. My question to you is, obviously we discussed that this is not supposed to be capitalized, right? Number one. Number two, my question is, when should we record it? When do I record an environmental provision? Do I record it at the time of the contract inception? Do I record it towards the end of the contract? Do I record the provision during the contract? What should I do? Come on, guys, I need your input. What do you think I should do? And if you let's say look at the screen and you tell me the answer, I'll have to ask you the logic behind it as well, right? You need to tell me the logic behind it. Any
Sir,
suggestions?
can sir, can you repeat the question again?
Yeah, I'll repeat the question again. We discussed in a contract there were two provisions, right? Number one was a dismantling provision because of a commitment that I made to the government that at the end of the contract, I will dismantle everything. I will take it with myself. I won't leave it here. I won't leave the oil rig and the parts and the machines over here. I'll take it with me, right? So that was a dismantling provision, was capitalized as per IAS 16. The second one is environmental provision based on a commitment to the government that whatever damage my activity causes to the environment, in this case, the marine life, I'll restore it. So the restoration has a cost. You cannot do it for free, right? It requires some cost. My question to you is, when do I provide for this cost? When do I make a provision for this cost? Because for the dismantling part, I made the provision at the time of the inception of contract. Should I do the same for the environmental provision? Or should I record the environmental provision towards the end of the contract? Should I record during the contract? What should it be? What do you think it should be?
Sir, at the time of inception of project.
All right, at the time of inception of project. Now, forget environmental, focus on provision. Three conditions. I'll just talk about the first condition, probably you'll understand. Present obligation as a result of past events. At the time of inception, of contract, that means the time when I signed the contract with the government, what damage did I cause to the environment? Did I cause any damage? Was there any past event which reflected any damage to the environment? Just by signing the agreement, I caused damage to the environment. Is that so? Obviously not, right? So in order to record a provision, you need to have a present obligation, number one. Number two, let me give you another logic why we won't record it at the time of inception. Present obligation. My commitment at the time of inception of contract, listen to me very carefully, just put yourself in that position when you're signing the contract and you're making this commitment to the government. At the time of signing the contract, this obligation is a future obligation. Why? Because this commitment will be settled in the future. This is not a present obligation. This becomes a present obligation as soon as I start my activities and I start causing damage to the marine life. That is when present obligation arises as a result of past events. So the past event was doing the activities that we do for oil drilling, right? And causing damage to the environment. That's a past event. Because of which a present obligation came into existence that I'll have to settle or I'll have to restore the damage that I'm causing in the future. All right. So now the point is environmental provision is created every year. Environmental provision is created every year at the future expected cost of restoration. And since it's a future cost, you discount it back to reflect the value as of today, which is known as present value.
So basically, what we will do is like not when we sign the contract, only when we start the activities, and then like unwinding and
Only when we start the activities is one. If your activities are causing damage immediately, you start recording the provision. All right, because that is when the present obligation arises. The
no,
condition
but
was that
then there are times when we don't know when the damage actually started. So I mean, we can just start it as soon as the activities start.
yeah, exactly. That's the yeah, exactly. What you're saying, what you're implicating is correct. Exactly. All right. So let's say when you
Means,
start drilling the seabed, that is when you expect to damage the marine life. Simple as that. So the drilling itself is reflecting that you have to record a provision. Okay. Yeah. Any other questions? I guess I heard some voice. Nikhil, you were asking something?
means that there has to be past event. After the past event, we will start a provision.
Past event means that, past event creates an obligation for you. Past event, it's, don't take it into isolation. Past event basically creates an obligation on you, right? So that obligation is to be settled in the future, yes, against which you have to record a provision, right? Past event, for example, let me give you an example. As per law, as per law, if you, let's say, have you studied F4 law, right? Have you heard the term battery? Battery means that you threat someone with, threat someone, of killing them. That's battery, right? So if let's say you do in the context of law I'm talking about, if you do battery, right, and if that person and based on evidence files a case against you, you'll have to settle a certain amount, right? Now, as soon as you do that, as soon as you point a gun towards that person, threatening of killing him, you don't kill him, you threaten to kill him, that constitutes as a past event because of which the court will say that you have to pay, let's say, 50,000 rupees to that person against whatever act you did. Okay, so this is what I mean by past event present obligation as a result of past event, right? So the past event becomes you raising a gun towards that person, right? And because of which the court will ultimately ask you to settle it for 50,000 rupees, for example. You understand? So that 50,000, obviously at the time you pointed that gun, became a past event, because of which you'll have to settle in the future, and this becomes your present obligation. Why present obligation? Because you, I would call it like this. For example, it becomes an obligatory event, right? This obligatory event creates an obligation on you that you will have to settle in the future. You understand now? So it's similar to this concept that, the moment you start doing the activities, let's say the moment you start drilling the seabed, that is when you start causing damage to the environment. And as per the government, as per the agreement that you had with the government, it said that the moment you start causing damage to the environment, you'll have to restore it as well, right? So obviously this is not the exact, this could not be the exact wordings with the government, of the comment from the government, but again what you have to understand is that, let's say the commitment is, let's say this is one of the terms, right? Any environmental damage caused shall be restored by a company, right? Now, any damage caused shall be restored by a company. Do I cause the entire damage just by putting in the first drill? No. I'm here for another 5 years, and I'll be causing the damage for another 5 years, right? So all damage accumulated will ultimately give me a restoration cost. This is what I'll have to restore, against which I'll have to incur a restoration cost, right? So as and when I cause the damage to the environment, I record a provision, all right, because it adds to my restoration cost, right? You understand? Because let's say I kill one fish today, right? I create a provision of putting one fish, buying a new fish from, let's say, someone else and putting it in the sea, right? Another day, I'm not doing it right now. I'll do it towards the end of the contract. I'll settle this restoration cost towards the end of the contract. But since I killed this fish today through my drilling activities, it creates an obligatory event on me that I'll have to buy a new fish in the future, and I'll have to put in the sea. Okay. Second day, I kill another fish. Third day, I kill another fish. Fourth. So each and every day when I'm killing a fish, it is adding to my cost. So what I'm doing is I'm creating a provision every day so that it reflects my future cost of buying all the fishes that I've killed so far, and I have to put in the sea. You understand?
Yes, sir. No, understand.
Are you sure? If you still have any confusion, you can ask me.
No, sir. I understand.
All right. Now, provisions for future operating losses. Operating losses means a normal loss there's a loss in the P&L statement, right? Overhauls and repair costs. We know what overhauls are, right? From IAS 16. And repair costs. Even if the repair is required by law, listen to me very carefully. You might get a question in your exam. This is there's a chance that you get this, Emma, you get this in SBR. All right. Even if it's required by law, you will not create a provision for any repair cost in the future. For example, the airline industry is highly regulated. Okay, a lot of laws apply on the airline industry and the companies that own or that lease the airplanes, right? There's a law which says, for example, that you have to replace the engines of the plane after 40,000 flying hours. So obviously the flying hours are being recorded on the plane itself, right? Each plane has its own record, which records the flying hours, how many hours, has it flown. So what you do is, once it hits 40,000, and the inspection teams is they're there. Obviously it's an airline, right? It's an airplane, so it has a huge risk if you don't abide by the law. Okay, so even though the law requires you to replace the engine after every 40,000 flying hours, it does not create a present obligation till the day it hits 40,000. Why? It creates an obligation, but a future obligation, not a present obligation. Provision is to be recorded when a present obligation exists. An obligating event comes into existence. An obligating event in this situation only comes into existence when the plane hits 40,000 flying hours. You understand? Because that is when I have to replace it as per the law. Okay? So repair costs, any overhauls, any future operating losses, you will not record a provision against these things. All right? As per IAS 37, you cannot, because there's no present obligation. There's no existence of an obligating event. Okay? You guys get it? Nikhil?
Yes, sir.
All right. Ahmed, what about you? Rushal?
Is there anything like any other company that has the same issue apart from the aeronautical people? Because I think these they are an exception, right?
No, yes, they're an exception, but for example, let's say the shipping industry, right? So shipping industry also has, it's not that highly regulated, but it is. It is. All right. I'm not exactly sure about, the shipping industry is getting there. If there's any law to, replace the shipping parts, right? But a ship has a life, 20 years. Let's say I know about containers because a friend of mine is in the business. So he told me about containers. Yes, a container is to be discarded after maximum, if it's of the utmost quality, I guess 8 to 10 years. That's the life max. After that, it cannot be used in trade. You can use it to road the to block the roads. What we do in Pakistan and India.
Mm,
That's the best use of container that cannot be used in international trade. So you can use it to block the roads. You can use it to you know disturb people, right? But you cannot use it for international trade. So yes, if that, because for a shipping company, they have to replace the this container, or let's say they have to replace, let's say, a body or a part of the container, right? After every 5 years, after every 4 years. Again, it's probably not as per the law, it's probably as per the industry norms, but it still doesn't create a present obligation as of today. It only creates a present obligation once that time has passed, once an obligating event triggers. Okay, so that is the point. Now, one last thing that IAS 37 talks about is restructuring, right? First, we need to understand what restructuring exactly is. A business is said to be restructuring, or let's say restructured, when it changes materially. All right, when it materially changes the scope of business. Scope usually relates to your, let's say, the services or the goods that you're selling, right? Services or products, right? So if you materially change, it's not expansion, by the way. All right, you can say that selling off a line of business. For example, Unilever sells off Sunsilk, right? That could be restructuring, right? Because that's a material change. Sunsilk is a huge product for Unilever, right? Now, that's one, right? And the other one is, if you are materially changing the way in which the business is conducted, the manner in which the business is conducted. So for example, you can say that you're shifting your headquarters from, let's say, from India to China, right? That's a significant change, right? That could be a significant change, a material change, right? So you can say that, you know um, let's say I gave you an example of Unilever shutting down Sunsilk, right? You can say that Unilever withdraws its operations from Europe, right? Or you can say that it basically goes from India, the headquarters goes from India to China, right? So all of these events become material, and that affects the way the business is conducted or the scope of the business. All right. In that case, you said that you're restructuring the business. All right. A provision based on this restructuring is only created because there's no legal obligation. Remember this. There could be legal obligations, but very little. Most of it is constructive obligation. Why? Because when you lay off the people, or let's say when you incur the restructuring cost, right, you have to provide for it on the day these two conditions are met. All right, on the day these two conditions are met. Condition number one: a detailed and formal plan should be approved by the management. How do you know that a detailed or formal plan has been approved by the management or not? The most authentic source of document is board minutes. Okay, this can be verified through the board minutes, whether it's been approved or not, whether it's been authorized or not, whether this plan has been put in motion or not. Okay. Number two, valid expectation is created amongst the affectees through a formal announcement. Formal announcement does not mean that the CFO comes in one day and he brings in a loudspeaker and he starts shouting that we're restructuring, we're going from India to China. No. Formal announcement means that how do you formally communicate in a business environment? Probably through email, right? Through email, or through, let's say, in more sophisticated environments, you communicate through a notice, right? Notice is put out on the notice board, which probably every employee checks every day, right? So the point is, such formal announcement should be given to the affectees, and obviously this formal announcement will create a valid expectation amongst the affectees that they're going, right? And we are restructuring, and obviously at this instant is where you create a provision for the restructuring cost. Okay, guys, you understand this? Now the restructuring, Nikhil, do you understand this?
Yes, sir.
All right. Now the cost of restructuring, or the provision that you will make, will only include directly attributable cost to undertake the restructuring plan. Number one, they will never include costs related to ongoing activities. They will not include costs related to ongoing activities. What are those costs? Like what costs are we talking about over here? Ongoing activities means that this, for example, this cost is necessary for the operations to continue. That is called an ongoing activity cost. All right. So first of all, for example, the most basic cost could be relocating the staff, or let's say retraining the staff, because this only relates to, why would you relocate staff? Because you want to go on with the activities, right? Why would you retrain the staff? Because you want to go on with the activities, right? For example, cost of new systems to basically support the new business model, or to support the change in business model, right? Why won't you take the cost of new systems? Because it relates to the ongoing activities. It supports the ongoing activities. All right. What else could be there? For example, yes, a very important thing which people fail to identify: profit on disposal of assets On what disposal? On the business that, on the part of the business that is being restructured, right? So if you dispose of the assets, the profit shall not be recorded as part of the provision because that's a gain. All right, you understand? And in the same scenario, in the same case, any future operating losses are not supposed to be recorded as as part of the restructuring provision. Okay, guys, you get it?
Yes, sir.
Each and
Sir,
everything.
sir,
Yeah, you have a
sir,
question?
yes, if they are retraining the staff and they cause the damage to the machines, that will be the provision.
No, no. Why would that be a provision? Give me the logic behind it, and then I'll give you the logic why it shouldn't be a provision. First, I want you to know I want to know your thinking process. Why do you think it should be provided for?
Sir, if they are retraining the staff, that is not a provision, that is a ongoing activities. So if they are retraining the staff, if there has been a loss or there has been damages in the machines, so
Okay,
sir,
a damage. Okay. Tell me something. A damage to the machine is an anticipated loss or an incurred loss. Is it a loss that has been incurred, or is it a loss that's been anticipated right now? It's an incurred
incurred
loss. Incurred loss.
loss.
So why do you need to create a provision for an incurred loss? Incurred loss is supposed to be recorded right away. You understand? Incurred loss is supposed to be recorded right away. You don't need to provide for an incurred loss. It does not make sense because provision is for something that will happen in the future. Okay? The provision is something that will settle in the future, that will cause a loss in the future, not right now. But yes, because of the obligation today, it causes a loss in the future because the settlement is in the future. Okay? Whereas you're saying that because of the retraining the staff, for example, they mishandle the machine and they cause damage to it because they're just being trained right now. They cannot be perfect at it. They're just being trained right now. Yes. So they mishandle the machine and they cause damage to it. Now that damage has already caused the loss. The loss has been incurred now. So incurred loss is always supposed to be recorded in the P&L right away. You understand?
Yes, sir. Yes.
And there's another element of it. Did you look at IAS 36, impairment of assets? If the machine has been damaged, you immediately or basically at year end or whatever the suitable time is, you basically do the impairment testing of that machine. Okay. So the loss should be recorded in line with the impairment of non-current asset. All right.
Yes, sir.
Okay, perfect. So this is it for today, guys. IAS 37, right? In the next class, we'll look at another standard and then we'll do the kit for these standards. Next class will be on IAS 21. All right. Effects of change in foreign currency. Okay.